Moving along to our Did You Know segment today, we're going to talk about co-ops. Co-ops are a little bit of a different animal. We talked about condos before, and condos, you are purchasing a unit, which is that physical space in the development. You have an HOA cost. You have an association that's managing common elements. There's a master insurance policy covering the structure of the building outside of your unit, as well as maybe amenities and things like that. Co-ops are a little different. Co-ops, you're actually purchasing shares of the cooperative. That's what co-op stands for. It stands for cooperative. Shares of the business that is that property. And so that property gets taxed with one major tax bill. And your share of cost is based upon the size of the unit you're purchasing in that co-op. So it's a little different than condos because you're not actually owning necessarily that physical space. You're owning shares of the cooperative that are directly proportional to the size and the space of the unit that you are purchasing. That also has implications for what those fees are. One of the tangible differences between a condo and a co-op is the fact that your association fees, if we're talking with the condo language, translates to co-op fees. And the co-op fees actually include taxes and that master insurance. So you can kind of think of it this way. Your HOA fees, when you have a condo, are inclusive of the master insurance for the building and the structure and amenities and whatnot. With a co-op, your taxes are part of that number, as well as the amenities, as well as the master insurance for the building and all of the upkeep. So you don't actually have your own tax payment. You don't actually have your own tax bill when you have a co-op. You only have your co-op bill that's monthly for your dues that are due every month, which has baked into it a portion for your taxes. So that's one of the major differences there. There's a couple other differences when you're shopping for a co-op that I wanted to highlight. So co-op lending is quite a bit different, and it is a little bit more difficult to qualify in the sense that normally co-op boards, which are comprised of unit owners and people who run the co-op, are involved in creating guidelines that the co-op has for people who would like to own there. So if you're not purchasing a co-op with cash, there is very likely going to be implications from the co-op board with respect to what type of lending you can get. Now, on my end, I have investors that I work with here at Rate that offer lending for co-ops, and there's a range of different possibilities. By and large, you should be prepared for 20% down minimum. However, when it comes to the co-op boards, they may require you to have a 25% down. They may require 30% down. Why they do this is to ensure a certain level of financial capability for their unit owners. That could be some of the mentality. There could be any number of things. Some of it could be in reaction to, issues that they've experienced in the past. So they've tightened up their requirements for unit owners. So that means if you want to have share of that co-op, you may have to have 25 or 30% down. In addition to that, you need to get approved by the co-op board in order to purchase that unit. So we have our mortgage approval process. Think of that as process numero uno. We're taking care of the numbers, getting everything ready for your financing. But then, once all that's ready, there's a whole application and approval process outside of the process that myself and my team manage for you so that you have to get approved by the co-op board. So you may have to complete an application, pay a fee, actually present yourself and go to a meeting of the co-op board to be interviewed and be approved to purchase. Even if your financing is good, it may not mean that the co-op board approves you to purchase that unit. So that's something to be aware of. Now, there's some other things that could be implemented here by the co-op board outside of down payment. Sometimes co-op boards get so far into their requirements where they actually have their own debt to income requirements, where they will say you can't purchase here if your debt to income ratio is more than 40%. Meanwhile, on my end, I may be able to lend to you with a co-op loan for 45% DTI and 20% down. But the co-op board may say, no, we have a cap at 40% and 25% down is our minimum. So that's something to be aware of. There's also restrictions. When you purchase a co-op, you may not be able to rent out those units. They may not allow you to have renters. It may only be permissible to have primary residence occupancy. So that's something to check out. In addition, co-op reserves also must be sufficient to satisfy the co-op board and the lender. On my end, I may have reserve requirements for your qualification scenario. My reserve requirements may be different than what the co-op board requires. So we were talking about down payment. We were talking about debt to income. They may also require you to have a certain amount of money in reserve beyond what I may require as the person assisting with your financing. So there's quite a bit more intricacies with co-ops, but hey, probably thinking, all right, well, you're talking about a lot of obstacles and a lot of challenges. Is there a benefit? And the answer is yes. There could be a benefit to you buying a co-op from an affordability standpoint. If you happen to be in a position where you can put down the type of down payment that's required and you can get approved by the co-op board, then your monthly housing costs may actually be less. Now, there are certain co-ops that we need to approve as well. So you can think of it this way. You have your own finances that need to get approved to buy a co-op. Then you have the co-op board that needs to approve you. And then sometimes on our end, for lending purposes, we need to approve the co-op. So we're talking about 3 approval processes there. So the benefit, if it's affordability that's helpful, it's worth it. But if affordability is not really showing itself to you in purchasing a co-op, then maybe it doesn't make sense. But co-ops could be great. Some of the other non-tangible, like we're talking numbers, we're talking how the rubber meets road to purchase. One of the other things to consider is that co-ops normally have a good community because they're selective. And so having a good community could be a benefit that is not necessarily a tangible, but something that, if that's something that you desire, could be attractive and appealing and worth going through all of that process.